Hi everyone, welcome to this lesson. We're going to have some live examples of how we are supposed to use the previous concept that we talked in the previous lesson, previous sections of this lesson actually. So we want to just use this raw idea of the simplest trading setup as a foundation for any other setup that you're going to see. It doesn't matter if it is in this masterclass or any other places that you want to learn trading. So this one is the foundation that is helping you to decide and define your trading ideas. So as in the previous lesson, we talked about overbought or sold area, and we learned how to define it based on these trend lines, based on market structure break, and also even the retest of the previous or prior higher time frame week and shadow. So now that we have learned this concept, let's go and dive into the real examples. So here we have two time frames. One is 15-minute time frame, the other one is 1 minute. So here we have this trend swing, which is a little different from the protected high and low. If you want to just use protected high and low, these swings are protected as it is defined here, high and low, protected high and low. As you see here, it is broken to the upside and we're in consolidation phase. And we have this scan swing inside it. Now, you will learn about these phases, or we can call them cycles. We're going to have 5 types of cycles. In the future lessons, you will learn based on the momentum of the candle and order flow strengths. We're going to have different kinds of actually momentum, and this momentum define the way we're supposed to enter, because each setup works in a different condition, and you cannot use one setup in any places. Okay, so you need to know where on the market, I mean in the chart, you're going to use a special strategy. So now, if we want to just use the simplest raw idea without considering any detail about that, so as you see in 1 minute chart, which is here, so we have this candle, which is bearish candle, and we have defined this trend line based on this swing and that swing, and also if you wanted to just draw the other one, it could be here, but we have also this new swing which is formed here. If we just want to see the tension in front of the priced, it means that this line of defenses that the price needs to just go beyond or lie against it are this one and this one. Okay, it needs to just break them or show reaction to them. And other line of defense is here, another one here, another one here, and if we just connect them together, it gives us a trend line. Okay, liquidity up there, and also here down. So if we want to just go aligned with the higher time frame, it's going to be buy setup. So the length of this candle here is, as you see here, this is the length of the candle. Okay, look down. This range, this range is the length of the candle here. So in the close of the candle, we're going to enter buy, and because we are having RR more than 1, so this is our stop loss, and this one is, I think, 1.2 or 3. Okay, R that just we're going to just guess. Although this place, I don't recommend you to just take trades in any places. This place is really risky, and unless you're professional and you're experienced trader, I would never advise you to just trade in this environment, because it is very difficult and it is considered as range. But I wanted to show you that even in this environment, which is difficult, our simplest trading idea could work, and sometimes you will see that it won't work. So because of the market cycle change, where there are some other points that you need to learn in the future, and they're going to just give you the refined entry points, and they're going to increase your win rate and also risk per reward. Now, if we continue with this one, you'll see that here. So our stop is protected behind this one, and our target is achievable here or there. Okay, I'll define this one. Okay, maybe here. These ones are weak tensions. Okay, but this one is stronger because it belongs to higher time frame. You see here in front of the price. So now, if we want to just see it after 1, 2, 3 minutes, so our target is achieved. But will we just do again trading based on this trend line, this one? So no, because we have this tension in front of us, which is a strong tension, and our expectation is that price 70% or at least 60%, it will reverse back. So let's define the range of this one, and if we see that we can get a reversal trade here to downside, and as I said, it is a reversal trade and it is risky, and unless it has good risk per reward, at least more than 1.5, so it isn't worth taking it. So now this is our range of the candle. So this could be the place that our stop loss will be fall. Now here it is behind this one and this one. If it was there, it would be more safer, but because we don't know that how long and how far it could go as the target. So let's see if we can take this one, okay, as 2.4 risk per reward. I would go with 2, but in this one it was 2.4. Now look, this tension, the price has come and reacted to this tension, and we have a wick, which is sign of weakness, and you will learn it in the momentum concepts in the future lessons. That there, I could say that momentum is the king in market because it has the closest and the nearest relationship with liquidity and actually point of interest on the market. So here, if it was like this, instead of 2.4, we would have our TP in 1, 2, 3, 4 minutes. Okay, but now, because we didn't want for this 2 RR, we have to wait more. Look, after this 4, we have to have a lot of pressure, mental pressure. It would come to our break-even point. If we don't close the trade here, at the end of the day, it's going to deliver our target, but it is and the cost of giving this target is just breaking this tension area. And now, if you look at this one, this swing belongs to 15 minutes time frame, and it is a strong liquidity point. So we expect this blue line, which is actually tension for from the shadow to the close of the 15-minute candle, which is tension, and our point of interest, which is here our FTR, or fail to return point. So here we need to have reaction. So if we want to just continue just without having any concepts, without having proper context around our candles, and we just run after the candles and try to catch some pips. So here, if we want to like trade, so our stop loss would be hit. Now look at this one. Now this is our range. Okay, so if I go back, if we were supposed to go short here because we see bearish candle, and we want to just go and all the time run after the candle and have FOMO, fear of missing out. So see what would happen to us. Now here is our range, and we would go short here, and right away our stop loss would be hit, right? But now let's look at this one again. So maybe you say that, okay, now it is we have a strong momentum down. We got to go short here after the close of this green candle, but you have to just consider where you are on the market. This is liquidity area. Okay, this is the place that a lot of buyers and sellers had thought before to just drive the market up while it was going down. So it means that we have a lot of traders here, or let's say ITs or computers or hedge fund or whatsoever. They want to have the market up rather than going down. So there are some here under this swing point. There are some liquidities here. They need this liquidity to drive market up if it is supposed to continue with the higher time frame actually structure. So it means this is the worst place you could take your trade, sell trade. So, and here, if you are a naive trader and you put your stop here based on whatever you have learned blindly, and you go short, right away your stop loss would hit. Now, then if you were just a little bit actually aggressive trader or professional trader, and instead of taking this short here, because if you just measure this, the range of this last candle, so and extend it two times, the double of our range would be somewhere around here, I could say. Now, and like this one, if you were just defining these boundaries for yourself, to say that, okay, now my stop loss is hit, let me just go short here. Unfortunately, because we have our target will not be like 1-to-1 or more than 1-to-1, okay? And also the area that our stop loss would be protected are not going to be these places, okay? Unless we have a reaction, okay, which shows that, okay, it cannot go up, so, and it could get back down. How do we know this reaction? In the momentum lesson that is in the future lessons, you will learn them in depth, so we will have a very good way make it to define if it is going up or down, and you will just have a good guessing of like 70% that, okay, it's gonna break it or it will reverse here. Now, if we were just going buy, it was just buying. So here, instead of going short, look, if we were going long, our stop loss would be here, and our target, which is, although it is risky, but it is 1-to-2, and it is easily achievable. So this is the way that we used tensions as our roadmap. Okay, so if we don't have tensions and if we won't have zones, and if we don't have liquidity areas, so we are blindly just taking buy and sells, going short and long based on the candle. So it is not going to be in our favor, and we are ending up to lose our capital. So next time we're going to talk about the dynamic and static bouncing boundaries. So as you saw here, the importance of boundaries is something that you cannot ignore, and these are the things that they give you context in order to have proper trades. So although we are still here, if we were just trading based on what do we say? We could say percent, we would be in profit right now, although we're using this trading idea. But to have a better and logical way of entries, we want to have better places to enter, and we have to have proper entry points based on liquidity and based on mathematics. And at the end of the day, we will count the number of the pips we are in profit and deducting a lot of our points that we lost. So at the end of the day, if we are green, it means that we have just milk some points out of this market. So that is the important part. Some people are talking about risk reward, some people are talking about rate, but at the end of the day, it doesn't matter which one you're going with. The pips matter. What at the end of the day, after your overall pips that you're gathering in the market, are you in the profit or in the loss? But mathematically talking, you would never go in risk reward below R1 RR. It is possible to be profitable if you have risk reward lower than 1.1, but it is so difficult to maintain this high win rate. So if you have higher, win rate, that's okay. But I doubt it when you start doing so. So see you in the next video. Stay tuned. And if you have any question, feel free to just ask me in the comment section, or if you need any mentor, or if you want to just show your practices, you can contact me through the contacting Telegram, Discord, or any other platforms you feel like you need that. I can help you with your exercises. I will give you feedback, video-based feedback. So then I'm waiting for your practices. Take care.